Okay, good morning guys. This will be the last video for your class. It's chapter 11, just going over the homework problems 11.1 through 11.6 that we actually discussed in class, but you can have this for your review of the exam. So chapter 11. Okay, the first problem we discussed, and here it is. 11.1 we're asking, remember there are 5 methods to come up with the capital budgeting. So here, 11.1, we are basically outlaying $52,000 and $125, and we have a cost of capital, or rather WACC, weighted average cost of capital, at 12%. So we pay out $52,000. It costs us 12% to raise that money, and we're getting back $12,000 in consecutive cash inflows over 8 years. So essentially we have one project, and we want to see, is that a feasible project? Is that something we want to invest in? So problem's asking for the net present value. Simply plug all those variables into your cash flow calculator. Okay, so initially the CFO is $52,125. Okay, cash flow 1 is going to be $12,000. Okay, and because there are the same payments each year, you can simply put in first cash flow 12,000, and that's happening 8 times. So frequency 8, at an interest rate of 12%. So again, we always want to use the cost of capital. Discount that back to the present, okay? And we come up with a net present value of $7,486. So that's obviously a good return. So you can tell your boss, yes, we'll accept that project. Again, using the same numbers, you might have a company that looks at a project through the lens of internal rate, IRR. Okay, in this case, same numbers, but remember, you don't need any cost of capital. You want to see what is the internal rate. So we shell out this. We're getting these payments. Essentially, if you put all that in the bag, shake it up, see what my return is, and that comes up as 16%, which is good. Okay, the one criterion to use to determine if that's a positive, feasible project to undertake, as long as 16 is greater than the cost of capital, 12%. Then you can say, yes, I accept it. Okay, and again, we only have one project here to deal with. So, you don't have to, it's not a mutually exclusive or independent case. It's just one project. So here, I guess you can't see that. Internal rate is 16%. It's greater than 12%, so we can accept it. I'm going to move that back just a notch so you guys can see it. Adjust my camera. There we go. Okay. 11.3 is moving on to the third method, which is modified internal rate. Again, we're using the same numbers, but we have to do a couple things. Step one is determining the terminal value, which is when the project ends, which is TV, terminal value, and that of course comes at the end, period 8. And that will function, that will operate identically the same as the future value. So when we get the terminal value, that's in essence what we've worked with all semester as your future value. So we have this outlay. We're getting $12,000 each year. We want to come up with the future value of each of these payments. As we discussed in class, there are a couple of ways to do this. The way that, conventional way, if you will, is getting each payment and finding its future value, and then adding all those up. The last $12,000 is face value. It does not compound. All the others, however, that come before it are compounded at 12%. So, for example, your first $12,000 is $12,000 compounded up to here at 7 periods at 12%. That's going to give you obviously something greater than 12,000. Add all those up, and that will give us our future value, or the terminal value, of $147,596. So we lay out those inputs for the time value of money. N, of course, is 8. We're looking for I, which is the modified rate that we are trying to come up with. Because remember, internal rate is probably too high. We want to modify that, bring that down to something that's more realistic. Because as the project progresses, the company would take that money and reinvest it at some rate to earn money while the project moves along. Okay, so that's what we're trying to get at. We have this. Present value is what we paid out initially. Payment doesn't matter, so that you can make that 0. Put all that into your calculator, and you should come up with your modified rate. Okay, so we plug all that in, and we come up with 13.89. That is your modified rate. That should, if you've done it correctly, that should fall between two numbers. One, the initial cost of capital, and the internal rate. It should fall somewhere in between that. Not exactly in between, obviously, but somewhere in between those two numbers. Now, we discussed a couple of alternate ways to do this. Okay, that's not the only way. And that's what you want to do as you progress in finance and some of these other classes. Think of other ways based on the skills and techniques you've used, how to come up with maybe an easier way or an alternate way. There are a couple ways here to find the TV. Everything else we have. The terminal value, we can actually treat it as an annuity, okay? Because it's $12,000 each year, so that's a consistent payment. We can plug that in as we've done before as an annuity. N is 8. 12, okay, is the cost of capital, weighted average cost of capital. PV in this case that does not come into play. We're looking for the future, and payments are at $12,000 for 8 periods. Again, that's basically the future value of that annuity after 8 years. And that is the same number, $147,596. Remember, do not put in the present value, because that's not what we are looking for at this moment. Okay. The other way actually is to take all those 12,000 payments, bring them back to the present, because that's what your calculator can do, get some number, and then kick it out to the future. We've done that in chapter 5. Okay, so that's actually 3 ways to do it. Problem 11.4. Again, we're looking for the payback. This is pretty easy because it's $12,000 each year. We've paid out $52,000. If we're getting $12,000 consistently year after year, simply see how many times that goes into $52,125. That is 4.34 times. So your payback period is 4.34. The discount method. Okay. Don't make this any more difficult. It's pretty simple. We're simply accounting for the buying power of money or purchasing power of money or lack thereof. So each of these 12,000 payments that you're getting, you want to take each of those back to the present to see what it's worth today. You're getting 12,000, for example, one payment in year 8. What is that value? What is that value today? Because if I lend you 12,000, you pay me back 12,000, 8 years. I've lost 8 years of purchasing power. So we want to take that amount and translate it into what it's equivalent to today. That will give you the new amounts to then offset with that, in this case, the 52,125. So think of that 52,000, okay, as your debit. You've paid that out, and now you're going to get some credits. You're going to get some credits to offset that amount and to see how long that takes to clear that balance out. Okay, so you have to first discount each of those payments, okay, at the 12%, the cost of capital. Okay, you get the new amounts, and now you start crediting 10,714. That was first cash flow. Second one, third one, so forth. And the only thing you have to worry about now is the last payment before you cross over. You need to see that last year, how much of that last year will zero things out. Everything else is going to be a full year. You know, year 1, year 2, year 3, year 4, etc. So in this case, we had the amounts cleared out 6 years, and we got to the 7th year, and it's going to be a partial year because we only had 2788 as a debit left over, and this is what we received at a discount. So it's a partial year. So it's 6 plus that, whatever that equals. You know, it's about 50%, 51%. So your discount payback period is 6 years, 0.51. So let's call it 6.5 years. The last one, this is a nice problem because it looked at different costs of capital, two projects, Project A, Project B, and they were both subject to different cost. You know, cost of capital, working cost of weighted cost of capital. In some scenarios, one project was better. Some scenarios, it wasn't. Okay, so at 5%, each project had a positive outflow. Okay, 3.52. Project B, 2.87. So if these are independent projects, we can accept both. If your company says treat it like treat it like a mutually exclusive, meaning you have to pick one or the other. In this case, they're both positive, both greater than 0, but Project A is greater. So you would tell your boss, for example, Project A is the best. If we only pick one, let's pick A. If cost of capital is 10%, we can see that if it's mutually exclusive, then B is actually the better project. Okay, this is greater than that. If it's an independent scenario, at 5% and 10%, you can pick both. Moving over to 15%, they are negative, so both are losing propositions. So you would, regardless whether it's mutually exclusive or independent, you would reject both of these because it's a negative number. Now turning to internal rate, remember internal rate does not matter. When you're looking at the internal rate of return, the cost of capital does not come into play. It's simply what you've shelled out, what you've received, and then what that yields, what that generates. So project A had a 11.10% internal rate. Project B had a 13.18%. So obviously, project B would be better. Okay, that's it. Thanks, guys.